Hello, and welcome to this evening's session, Financing Small and Growing Firms. I don't think that many people would disagree that there is what feels like a very big problem in the UK economy at the moment. Growth is stuttering either side of zero. Projections going forward are very weak, and Britain could be heading for something approaching a lost decade. And at the centre of that is probably nothing short of a crisis over our smallest and most important companies in society, SMEs. I think everyone would largely agree that they are the engine room of the British economy. It's where ideas are tested, creative destruction takes place, and where the British economy renews itself and is the bedrock of employment and ideas and society. So, but at the moment, that sector is not receiving the funding that it should do. During today's event, we are extremely lucky to have 4 people who are experts in their field about what to do about this. It is entirely unclear what the way forward should be for funding of small companies. Some people blame the banks. Do banks have enough money to lend to small businesses? Are banks constrained by domestic and global rules over holding too much capital, or penalised even for trying to lend to small businesses? Should we be relying on banks at all? Aren't there a range of other alternative investors who could help kickstart ideas and make sensible returns in the process? Or is it simply that there aren't the ideas and the companies willing to expand? There isn't enough demand out there to really justify the accusations that currently are being levelled against the banks for not lending. And then what should we do about it? There are all sorts of ideas floating around. It doesn't seem quite yet that there is a coherent direction from government. Some people talk about a business bank, but I think we're still very much waiting to see what that might look like. People are talking about whether or not to reform cheap money schemes from the Bank of England. Funding for lending is one that's being talked about quite a lot at the moment. The Bank of England is quite defensive about the scheme that it launched last June, and despite pretty dismal figures about the amount of money it's getting into the economy. Or should we be looking for supply side reforms, cutting, for instance, youth unemployment rate in order to allow businesses more scope to take on new staff and to try out ideas without the fear that their balance sheets will become overburdened and they'll sink before they'll be able to properly give their ideas a go. So 4 people are joining us today. From right to left, to my right to left, we've got James Barty from Policy Exchange. James is a former banker, former hedge fund manager, worked alongside Sajid Javid, currently Treasury Minister, and is about to release a report on the banking sector for Policy Exchange. Julia Groves. Julia is chair of the UK Crowdfunding Association, a group that you almost certainly haven't heard of because it was launched at 2 o'clock today. She will be essentially a self-regulation body to explain how potential investors and businesses can connect, and setting some sort of minimum standards to provide some self-regulation in what is a new and sort of emerging area. Steve Pavement, we're very lucky to have. He is UK head of banking at Santander, and really a veteran of the retail and business banking sort of expertise. He's been with NatWest and RBS for many years before joining Santander. And then Michael Fallon, a familiar face to many of you, business minister, Shostakovich fan, and has just emerged from the House of Commons where he's been talking about apprentices. So thank you all for joining us. I thought we might just start with some brief remarks, and Michael, if you want to go first. Yes, please.
Well, thank you very much. The success of SMEs is obviously integral to generating growth. They're the backbone of the economy, I think we can all agree on that, generating nearly half of private sector output. Fewer than 10% of our firms generated more than 50% of all new jobs in the last 3 years. One of the biggest problems they face is accessing the finance that they need. So let's just start with the problem. The number of SMEs using external finance is falling, has fallen, is falling. Many are discouraged from applying, even by, often by a negative media portrayal or being told that banks aren't lending. Only 1 in 10 SMEs applied for funding in the past year. Most of those were successful. 75% of overdraft applicants, 56% of loan applicants actually did get finance. But these figures need to be much higher. What are we doing in government? First of all, with the Big Four, who dominate SME lending, we've put a package of measures in place to address the lack of credit, but we do need the banks to do more. First of all, they need to take up government schemes that are there. Funding for lending is a major scheme to boost the availability of credit, but it seems at the moment to be benefiting the mortgage market and not getting through to small firms. Paul Tucker conceded last month, I quote, "The bank's current policies may not be reaching as far into the SME sector as we would like." So we need to do more work there. I should be meeting Paul next week with Vince Cable to discuss what more the Bank of England can be doing. Often SMEs struggle to get finance because they simply haven't got sufficient trading record or collateral. The Enterprise Finance Guarantee has helped nearly 10,000 SMEs by providing a guarantee. 80% of those EFG users would not have been able to secure a loan through conventional lending. And those aren't poor quality businesses. Those who've received an EFG loan have grown the same way, the same pace to other businesses. So we are making inroads into the issue of firms with insufficient collateral, but we are also looking in the department and with the banks as to how we might maximise the impact of the EFG scheme, given the other factors that make up lending decisions, such as affordability and repayment. Secondly, relationship banking. There is a view amongst SMEs that the Big Four have lost focus on relationship banking. I think the real picture is probably a bit more nuanced than that. They are beginning to rebuild their networks, and of course the challenger banks like Handelsbanken are making great inroads in this particular area. Aldermore, for example, have 1 relationship manager for every 40 business customers. I'm particularly interested in the quality of the advice they give. I understand that RBS is the only bank that has relationship managers independently accredited, something other banks may wish to consider. Thirdly, there's transparency. We have committed now, as a government, to greater disclosure of SME lending data, so that all of us can see, and members of Parliament can see, what the banks are actually lending to SMEs and where they're actually lending it. We've asked the banks to be ambitious in agreeing an approach to publishing SME data, but if they can't do this voluntarily, then we are ready to legislate. Fourthly, appeals. One area I remain concerned about is whether banks are really close enough to their customers to make proper lending decisions, or whether too many of them are simply relying on national credit scoring systems, or indeed banks that set specific criteria sector by sector. Too few SMEs are aware that they have the right to appeal a bank's lending decision. 40% of declines that are appealed are overturned, which tells you something about the quality of the original decision making. That's what we're doing with the Big Four banks. Now, it can't be right that 85% of SME lending lies in the hands of those Big Four. That isn't competition. That's an unhealthy concentration that has been reinforced by protective regulation and a privileged place at the heart of the payments system. The FSA is going to publish its review of barriers to entry for new banks this month. I hope that will bring about real improvements in the process and the pace of authorisation of new banks, as well as giving them more time to build up proportionate and more proportionate capital requirements. Reforms to the payment systems that the Chancellor has announced will mean they will get equal access to the infrastructure they need to operate. But we can't be complacent about removing barriers to market entry. Given the measures we've now got in place to protect depositors on the one hand and to ensure rapid resolution of failing banks on the other, I think the regulators now need to show more leadership. Otherwise, I think there's a real danger that a risk-averse and micromanaging culture will inhibit competition that we want to see from new entrants. Finally, if I may, probably overrun, a word on non-banking and peer-to-peer lending. Much of the debate on lending obviously focuses on bank debt, but equity and non-bank lending have a crucial role to play. That is why we are increasing our commitment to venture capital and bridging the equity gap for innovative SMEs. Enterprise capital funds provide around 300 million for firms with the highest growth potential. The Chancellor has committed 100 million for non-bank financing, 55 million has been pledged to peer-to-peer lenders and other finance suppliers, and will shortly be announcing successful bidders for the remaining 45 million. Finally, the business bank that Sam touched on. Government is building a business bank to tackle some of the long-term structural problems, as well as consolidating some of our existing finance schemes, ones I mentioned like the EFG. The business bank will increase the provision of finance to viable but underserved businesses, in particular long-term finance. It will receive £1 billion of funding, 300 million will be co-invested over the next 2 years to provide diverse sources of finance for SMEs, and you will hear more about that in the budget. In conclusion, providing businesses with accessible finance and support, I think, is essential to give SMEs the confidence they need to invest. We'll continue to work with the banks, the established banks, on this, but we'll also continue to challenge them and the equity investors and other private finance players to ensure we have a diverse and readily available supply of finance that new and small businesses need to continue to grow.
Good afternoon. It's good to be here today, and thank you for joining us. As some of you will know, and I hope the panel will know, it is Santander UK's ambition to be the SME bank of choice across the country. I know that bankers can have a habit of making big promises that turn out to be somewhat empty, so I am pleased that I can back up this ambition with some excellent progress today. Santander only started developing its corporate and commercial banking business in 2009 after the acquisition of the Alliance and Leicester business. And since that time, we've consistently grown our net lending by around 20% per annum. And last year we grew by a further 18%, making £3.5 billion of capital available to our SME customers. The numbers I give you are not gross numbers, they're net numbers. It's a function of us being a relatively new bank in this space and a challenger bank. But our commitment to SMEs can be seen beyond the numbers that we lend. We developed in the back end of 2010, early part of 2011, a broader commitment to SMEs under the banner of the Breakthrough Programme. At the heart of the Breakthrough Programme is a £200 million growth capital fund for fast growth SMEs. This fund is unique because it is comprised entirely of mezzanine finance. That's debt capital that acts like equity capital, so businesses are able to focus on growth rather than being burdened by debt that needs to be repaid. But the most important thing about Breakthrough, and indeed the whole approach that we have at Santander, is that it's more than just money. Breakthrough is about offering businesses a network of support for up to 5 years that includes trade missions to overseas markets, business mentoring, and funded internships for young graduates. And the success of Breakthrough can be seen through inspirational entrepreneurs like Julie Gash. Julie founded Bag It, Don't Bin It, which produces branded cloth bags as an eco-friendly alternative to plastic bags for brands such as Waterstones, Lush, and Liberty of London. And Julie joined one of our Breakthrough trade missions to the United States for female entrepreneurs. And the support that we were able to provide during the trip helped her to secure orders from clients in New York and Boston. She left the States with a strong contact book and has since returned to New York to follow up on the progress she's made. Breakthrough has made 5 mezzanine finance investments to date. We have a strong pipeline for 2013 and hope to make a further 25 investments this year. And I mention Breakthrough because I think it epitomises Santander's approach to working with businesses. We want to be a trusted partner of our customer, bringing more value to the relationship than just the quantum of money that we lend. We achieve this in our wider corporate and commercial bank by focusing on local relationships and more localised decision making. Our relationship managers are based in corporate business centres across the UK, and they only deal with businesses in their area. That means they get to understand the local economy and are better able to support the businesses that operate in that economy. We've put local credit partners into the corporate business centres, and they work alongside the relationship managers and alongside the businesses to help them put together the lending applications, acting as an advocate for the business when lending decisions need to be made at a regional level. Now, I'm fairly familiar with the fact that there's a huge amount of scepticism where banks are concerned. I'm sure that many of you are thinking, where's the catch? But actually, we think this model is good for the bank, and it's also good for the businesses we serve. Because by working closely with our customers, before they even make their application, we're able to provide financing solutions that are actually suitable to their needs, helps their businesses thrive and grow, and as a result produces a stronger and more sustainable customer base and a quality loan book for the bank. And in corporate banking, I believe the best rule of thumb is that what is good for our customers is ultimately good for us too. So having painted a very rosy picture of what Santander is doing, why do we still hear that SMEs are finding it hard to access finance? Well, I should be very clear, Santander is a challenger in the UK corporate and commercial banking market. The big four, as Michael says, have 85% share of the market, we have 5. But 5 from 0 in 4 years is not bad going. But to look at the bigger picture, I would suggest that there are perhaps 3 considerations when establishing why small businesses can't access finance and what the solution can be. First of all, we hear a lot about supply and demand from the banking industry, from businesses. That's what Vince Cable has called the dialogue of the deaf. And the question is finance a question of lack of demand or a lack of supply? From my experience, I think there is a bit of both. There is muted demand compared to where demand used to be. I've been in corporate banking for 20, 25 years, and certainly I think demand in the last few years has been much more muted than in the previous 25 years. But I would also say that during this period of time, banks have become much more risk averse in their assessment. There's very little upside in saying yes to something that goes wrong. There's very little downside to saying no to something that nobody knows whether it will be a success or not. And I think there's a lot of uncertainty out there that actually tends to lead people to be much more negative maybe in their assessment of the potential risks rather than positive. The other point that needs to be borne in mind is that I don't think it's going to happen, and I don't think it should happen, that we should return to the lax lending activity of pre-2008. Before the crisis, banks lent freely, much more freely than they should have done, and businesses paid less for the leverage that they should have had. So in other words, we were financing businesses with increasing leverage at cheaper prices, and that makes absolutely no sense at all. And it was this approach that nearly brought down one of the country's biggest banks, and it ultimately isn't good for SMEs. It wasn't good for the banks, and ultimately it's not good for the economy. And it makes no sense whatsoever to go back to that. So those that see a supply problem in the economy need to appreciate that some of the bigger banks do need to deleverage. They should also appreciate that some businesses which want more debt capital are not actually in a position to receive it. And now banks have a more sober perspective of their credit risk. They may be right not to lend it. And in terms of financial education, while the risk appetite of banks may have shifted, the rigour with which we make our decisions has certainly become tighter. The fact that money was so easy to come by in the period prior to 2008 means that there has been an expectation that all you kind of have to do is rock up at a bank and say, can I have a loan? And the reality is there needs to be a lot more support given by the banking sector and other agencies to help businesses prepare lending applications and to put the case and to make the argument as to why their business is one that we should invest in. So I think it is a combination of factors that have led us to where we are today. But I would make one point in response to some of the observations that Michael made. However good you think you are as a bank and however good your marketing people think you are, when you start a business from scratch in this place, the only customers who come to talk to you are the ones who failed to get their lending agreed at their existing bank. And therefore, for every 10 customers who came to see me in 2009 and 2010, I agreed to lend to 7 of them. But I knew full well that of every single one of those 10 customers, each of them had been rejected by their existing bank before they came to me. And yet we still agreed 7 out of 10 of the loans that came to us. And it's early days, but my loss rate on the lending that we have done since 2009 is currently around about 15 basis points. And that compares to an average for the previous decade of around about 65. So having taken on loans that nobody else wanted and agreed 7 of the 10, I still at this moment in time have a loss rate which compares pretty healthily with historic loss rates in the sector. And that would logically lead me to conclude that perhaps the risk appetite of the banking sector is overly cautious and has been overly conservative over the period of the last 5 years. Now, why are we able to come to a slightly different conclusion than some of our competitors? I don't profess to have any sort of magic dust in my office that kind of allows me to kind of guess the right ones. But I encourage my relationship managers to get to know their customers, to get to understand their businesses, to spend a lot of time getting to understand their customers and spend a lot of time getting to understand their businesses, and to use that understanding to inform their decision making so they come to the right decision. That doesn't mean that we always give a business exactly what they want, but I think it actually we give the business what we think they need based on what they've shared with us. So I do think it is about going back to some of the old-fashioned values of relationship banking and understanding your customers, not being led by scorecards and ratings, but being led by instinct and judgment. Turning to the wider market, I do think the government can play an important role in helping overcome some of the challenges we have. Actually, instinctively, I'm not in favour of the government helping me as a bank. I would like to think that actually I can deliver what my customers want myself without being given support and help along the way. But the markets do need support from time to time, otherwise they behave very dysfunctionally. And the funding for lending scheme is a very effective mechanism for lowering banking costs and improving access to liquidity in a market where liquidity has been very challenging for much of the last 2 to 3 years. This liquidity can be lent by banks into the economy and should help the supply side because it helps banks who need to deleverage more slowly. The scheme would be more beneficial to SMEs if it was focused only on business lending, or if the reporting requirements made a distinction between funding for lending money that is spent on SMEs and money that is spent on mortgages. Mortgage lending is much less capital intensive than SME lending, so banks are naturally tempted to use the FLS money for mortgages. The numbers that were produced for Santander for the last quarter on FLS showed a decline in our book of £2.4 billion. Within that, there was a decline in mortgages of £3 billion and an increase in corporate lending of £600 million. Actually, I was using exactly the same amount of capital as I was before. So in reducing my mortgages by £3 billion and redeploying £600 million into lending to SMEs, I used exactly the same amount of capital to achieve a very different outcome. But the number that is reported is a negative of £2.4 billion. The government can also help with some of the schemes it has in place to effectively shift the risk of lending. This decreases the level of risk that is taken on in some of the schemes, such as the Enterprise Finance Guarantee Scheme. By taking or at least underwriting a part of the lending risk, risk-averse banks can be more willing to lend. Outside of the specific schemes to help improve the flow of credit, the government should also take a macro view of how legislation in other parts of the financial services sector can impact access to finance for SMEs. There is no doubt that it is essential to deliver a stable banking system which never again needs to rely on taxpayer support. However, the government must be alive to the impact of imposing high and often super equivalent capital rules on the UK banking sector. The Federal Reserve of the US and the Bank of Japan have both warned that imposing the Basel III capital standards before the recessionary period has ended could knock 2% or more from GDP. And considering that European Union standards are super equivalent to Basel III, and that the UK standards are super equivalent to the EU standards, the government must be alive to how this can have a drag effect on the economy. I know it's hard to make a compelling case for relaxing capital requirements in recessionary times, especially when it was a banking crisis that partly contributed to this mess. But look at it like this. The globalised economy means that an SME in the West Midlands is not only competing with SMEs in Yorkshire or Cambridgeshire, but also competing with SMEs in Bavaria and Brittany. So France and Germany and the rest of the European Union have lower capital rules for their banks than the UK, but their SMEs will be able to access credit more cheaply than their UK counterparts. And this will make it cheaper for them to invest in new technology, new creatives, new skills. And it makes them more competitive than we are. So the government should be alive to the fact that capital ratios invariably lead to deleveraging and increase the cost, let alone suppressing the quantum of lending. My final point is the need to adapt to innovative solutions for SME financing. And I'm delighted that Julie has joined us on the panel today, because crowdfunding and peer-to-peer lending are an exciting innovation in SME financing. And in the longer term, I certainly believe that funds of this kind can bring true additionality into the market. I hope Julie won't mind me saying that in the shorter term, maybe peer-to-peer lenders need to work with bigger banks with established distribution mechanisms to make a bigger impact. In the current market, my concern is that an SME which can access funding from a peer-to-peer lender is quite likely to be a low credit risk and could probably have got that funding from their bank without too much trouble. So whether the business gets its funds from Barclays, Santander or a Trillium fund, it still gets its funding. And there's potentially great value in a partnership model where banks and peer-to-peer lenders work together to bolster the credit profile of their respective investee companies. One of the great advantages of some peer-to-peer lenders is their businesses usually have to prove their concept to a large number of individual investors. So for retail offerings, these investors are also consumers. So a bank may be willing to offer an SME half the funding it needs if it can get the other half from a peer-to-peer lender. And by bidding for the funds, the business proves the concept by attracting funding from a group of potential customers. Equally, peer-to-peer lenders may be more willing to work with potential investee companies if they know that a traditional lender has already put some money behind it. And this could reduce the risk for the peer-to-peer lender and make it more likely to work with the business. So in summary, we all have a role to play in working to free up credit to help SMEs grow and create jobs. The government plays its role by offering support schemes and through legislation it passes in other areas. The market is finding its own solutions through innovative channels such as peer-to-peer lenders. But the banks can and should do their bit. I believe that Santander has done its bit and will continue to do its bit by growing its lending and basing its values on a relationship model that we believe works well for us and works well for our customers. Thank you.
Now to Julia to find out about how non-bank lending can work.
Thank you for the opportunity to take part. I think I should perhaps start by explaining briefly what crowdfunding actually is, if there are any uninitiated people left in the room. So crowdfunding is simply when businesses raise money for investment directly from a large number of people who are putting in a relatively small amount of money. So whereas you might have raised £1 million from 10 high net worth investors putting in £100,000 each, you might now raise £1,000 from 1,000 different investors who are about as sophisticated as I am. It began originally in the creative industries, in film and music, and of course in the States, where you might donate £20, and for your £20 you would get a t-shirt from your favourite band, or your name in very, very small letters in the credits of the film. So originally donation-based, and indeed 10% of the films at the Sundance Festival this year were crowdfunded, including the first crowdfunded Oscar winner, a film called Innocent. But there are also crowdfunding websites that offer equity and debt finance for existing businesses, including Crowdcube, Seedrs, BuzzBank, and Abundance Generation, just to mention some of the more established names in the UK. The sector has experienced massive growth very, very quickly over recent years. The last valuation was about $2.8 billion worldwide. Here in the UK, peer-to-peer finance and crowdfunding sits at about 450 million, 460 million raised so far. So small beans for the financial services industry. But when you consider that Kickstarter came to the UK in January and did 2 million in its first month alone, we really feel the sector is poised for growth given adequate support. So I'm here because I chair the UK Crowdfunding Association, the UK CFA, not to be confused with the UK Cypriot Fertility Association, which shares a similar URL. And yes, the association has just launched. We have 12 members ranging across donation, equity, debt, regulated, unregulated. It's quite a lively table, if I can put it that way. We were set up for two reasons. First and foremost, to increase protection for crowdfunding users via our code of practice, which ensures minimum operating standards amongst our members. And secondly, to try and represent the sector and ensure that policymakers and government alike are taking necessary steps to allow the sector to flourish. So just briefly, what are the benefits and the risks of crowdfunding? You can tell I've been to FSA school because I always put the benefits and the risks in parallel at the same time. Crowdfunding is basically an alternative. An alternative means for companies to raise money at a time when traditional bank lending is diminishing. In the US, only 30% of funds and loans come from the banks, and in Europe the position is effectively reversed. And as the banks are retreating, we think there is a need for alternative providers to fill the void. And crowdfunding and peer-to-peer finance are leading the charge, but could be so much bigger than they are today. From an investor's perspective, it's pretty hard to actually overstate the potential for growth when you consider that only 1 in 3 of the high street banks can offer a rate which covers inflation. So crowdfunding is a vehicle by which idle savings can be channeled directly into SMEs, whilst providing a transparent return for the investor. So we're just trying to directly connect businesses that need investment with savers and investors that need a return. It's that simple. It's totally transparent, it's quick, and the low minimum investment amounts mean that even smaller investors can create their own diverse portfolio of direct investments across a wide range of sectors and risk profiles. And you can even make your customers your investors and vice versa, as was alluded to. The famous Pebble watch on Kickstarter. I think that if you can get 1,000 orders for a new watch design that hasn't even gone into manufacture and you pay for it up front, that sounds like good business to me from that perspective. Are there risks? Of course, all investments carry a degree of risk. The Crowdfunding Association Code of Practice really underlines the commitment of all our members to ensure users can easily understand what they're investing in, what the risks are, the possible returns, and what fees they may be picking up along the way. But please don't confuse the method of raising money with the product the investment's going into. Trillion Fund, for example, in my own business, is the boring end of crowdfunding. We refinance existing assets that have been in the ground for 2 years, solar farms and wind farms, with proven revenue streams, and we do it via retail bonds. It's debt, and it brings in new money. People like mum and dad and the taxi drivers who are very happy with a solid 5% return year on year, and provides growth capital for businesses that can't get it elsewhere. We've got a £500 million pipeline of potential raises, and if anyone really thinks there's no demand out there for this debt, they need to come and shadow some of the crowdfunding sites for the day and hear it from them.
Thank you very much.
Thanks. I'm James Barty. I run the financial policy here at Policy Exchange. I think when I look at SME finance, there's two things which really can stick out for me. First of all, in a UK context, and particularly compared to America, we have a high dependency on bank finance, and we have a low availability of equity capital, equity venture capital. And I know the government's been putting in a number of new schemes. The Enterprise Investment Scheme is a very good one. That's encouraged a number of business angels to start to create organisations that will put equity capital into SMEs. I do think, though, if there's one thing that can be looked at in government, it's actually joining these schemes up a bit better. They're all a bit bitty, and if you want to try and find individual investors, they tend to be individual investors, and I would like to see much more scope, for example, for something like a new 3i to come into the UK that would actually provide large amounts of equity capital into lots of SMEs. That's not been my main focus for tonight, because what I am going to focus on is the banking side, because this is what has traditionally provided SME finance in the UK. I'm going to pick up a little bit on what Steve said, which is that there's a major problem as a result of the financial reforms, and particularly the banking reforms that have been put in place since the financial crisis, which is causing SME finance to dry up. And just put some hard numbers on it. Under Basel II, which was introduced in sort of the early 2000s, if you wanted to lend money to a small and medium-sized enterprise, if you lent £100 to them, you had to put £8 of capital against that. If you wanted to invest in a subprime mortgage bond which was AAA rated, you had to put £1.60 of capital against that. If you wanted to lend to a mortgage with a roughly 60% LTV, you had to put £2.80 of capital against that. So banks were basically incentivised to not lend to small companies, but to go and buy subprime bonds, to go and lend in the mortgage market. And that created a lot of the problems in the financial crisis. And if you look at most of the banks that blew up in the financial crisis, they did one of two things. They either invested in AAA-backed, mortgage-backed securities, or they went on and made very bad lending decisions, going back to what Steve was talking about credit being too freely available. Now, the problem is that the other side of this financial crisis, what have we done? Well, we've tightened up all the capital rules. So as previously under Basel II, you needed roughly 2% of equity capital. We're now going to ask for about 7% of equity capital. Instead of 8% of total capital under Basel III, we're now, if you're a normal bank, 10.5%. If you're a global systemic bank, 13%. I'm afraid if you're in the UK and you have to ring-fence bank, it's 17%. So instead of having to put £8 of capital up against a £100 loan, you're now in the UK going to have to put £17 of capital up against that £100 loan. So actually we've created a problem. In trying to make the banking system safer, we've actually started to curtail credit. And it drives me nuts every time I hear, community Paul Tucker, racist Paul Tucker, or Charlie Bean, or anybody else in the Bank of England, because they stand up and they say, well, actually, I don't understand why funding for lending, the funding for lending scheme, enables banks to lend into the mortgage market but not into the SME market. Well, the answer is go back and actually look at the regulations which you're imposing on the banks. You're imposing these regulations on the banks where it becomes fundamentally more difficult to lend to a small company than it does to lend against a mortgage. Often 4 or 5 times as much capital. I sort of stumbled upon this when I was talking to a number of small companies, because the banks, and I've spoken to a number of regional loan officers to banks, and they will say, look, we will lend money. And to which my question is, well, how will you lend that money? Well, we'll lend that money if someone will put their house against it, or if they give us a guarantee against it, or if they give us the right interest rate. What they're trying to do is to lower the capital generally again they've got to hold against that loan. They're trying to bring it back to become more like a mortgage. If you then go to the small businessman, he'll say, well, actually, I want to borrow money from the bank, but they actually want me to put my house up against it, or they find a guarantee, or whatever. So often they haven't got enough actual equity within their house. It comes down to a problem of capital rules. So we've tried to make our banks safer, but actually what we've done in the process is to make our economy more fragile, because we cannot lend to SMEs. And frankly, Mervyn King can go and buy as many government bonds as he likes. He's not going to get the money supply growing unless you get credit growing. So I think there's a fundamental problem there. And to give you, one more clue to why I think the Bank of England got this completely wrong. When funding for lending came out in September of last year, originally it was proposed that if you lent money unfunded, and if your net lending went up, then any capital you had to put against the loan could be offset by taking money out of your capital buffer. So it was a good idea originally, because it basically meant you could lend without putting capital against it. The problem is, in November, 2 months later, the Bank of England turned around and said, by the way, I think you're all calculating your risk-weighted assets wrong, and your capital buffers aren't big enough, so now we're going to go and make you raise more capital for your capital buffers. By the way, the announcement for that one comes out one day ahead of budget. So I actually think the Bank of England and the FSA have played a major role in the drying up of funding for SMEs. And I think if we want the funding for lending scheme to work, we need to fundamentally change the way we do it. And you're absolutely right, we're trying to jump to Basel III way too early. And let's step back a little bit and let's ask what capital and banking is for. Capital and banking is meant to be supporting lending. What I want the regulators to do is to change the rules to say, actually, we want you to use your capital to lend, and therefore we're prepared to let you run down some of your buffers. We're prepared, potentially, if you get a little bit less safe, if you're going to lend money to small and medium-sized enterprises. So my proposal is design up perhaps a little bit less regulation, make the banks a little bit less safe, give them the ability to actually do what they were designed to do and go and lend. And just one more thing on regulation, sometimes you find bizarre regulations which cause real problems. There's another regulation under something called CRD4, which is the European implementation of Basel III, which relates to collateralized loan obligations. Now, collateralized loan obligations were a way for banks to package together debt, sell it to investors and get it off their balance sheet. So it was one way of freeing up capital. Under CRD4, there's something called a 5% retention requirement, which basically means if you issue one of these things, you have to hold 5% of it still on your balance sheet. The net result, I can tell you, is that in 2012, the US, that doesn't have this rule, issued $53.5 billion of collateralized loan obligations. European issuance of collateralized loan obligations, 0. So, if you want to actually try and understand why we've got a drying up of funding for our small and medium-sized companies, have a look at regulators, have a look at a lot of stuff that we've done to try and make the financial system safer, and let's try and move that pendulum back a little bit so that banks can get back to lending. Thank you.
Thank you very much indeed, everybody. Fascinating contributions. They go to the heart of what is actually the most important question when it comes to banking and small business, which is, do we actually think that banks are doing everything that they can to get money into the economy, or do we think that we need to look again at perhaps some of the rules governing banks and also our expectations? And what we have heard today, which you don't often hear in a public forum, is a bit of the case for the defence of banks, given the global and domestic environment that they are working in, which many politicians feel that they cannot address in public, because if you're seen to do anything other than banker bash, then there seem to be political consequences for that, and few politicians seem quite brave enough in order to be confident enough to do that in public. Now, I'm going to open it up to questions in just a second, but I'm going to abuse my position as chair by just asking just a very quick, one quick question of all of you. I just want to start with you, Steve. Michael quoted a figure in his speech. He said that 40% of appeals that have declined for lending are overturned. Isn't that the case for prosecution in one number against the banking sector?
Yeah, I can't but agree. On the basis that if in there a second pair of eyes looks at it and comes to a different conclusion, then by definition the first pair of eyes has got it wrong. So the question is why? There may be a number of factors. It may be that additional information comes out in the appeal that wasn't there in the first place. But secondly, I think it's very sad. I mean, I get letters from people who say... Is it computer says no? There's two things. Depends what size of loan you're looking at. Certainly in small business lending, there's a lot of scorecards. And if you've been a bankrupt or been unsuccessful in your previous business, that tends to count against you. In the US, it doesn't matter. So there's a difference between two economies. Secondly, I do think banking is about judgment, right? And no one turns up at the end of a lending decision and says, do you know what, you got that one right. You find out 5 years down the track whether you got it right or not. So it's a judgment decision. And actually, two people will come to a different conclusion about the same thing. Doesn't mean that one's right or wrong. I think actually there probably needs to be a little more case for the SME, and perhaps a little bit less about, well, this could go wrong, and this could go wrong, and this could go wrong, and this could go wrong. I mean, I sit on credit committees, and I think sometimes there is a case, well, everything that could go wrong is going to go wrong, so we won't do it. And actually, I think you've got to look at the management of the business and say, well, if stuff didn't go according to plan, frankly, I've never seen a business plan deliver pound for pound on every single line in my life. Do you think the management are good enough to adapt and change their business model? And actually, if they are, then actually back them.
Michael, just a quick one for you. Steve said that we were never going to return to the days of the sort of lending heydays of the mid-2000s, that period is over, and in a sense, people, politicians, business groups are setting expectation too high and then blaming the banks when they can't deliver. Isn't there a perception problem here, and aren't people, politicians, you stoking it?
Well, clearly we're not going to get back to the heyday of the early 2000s. I remember it well. I was in business, and if you didn't get a loan from one of the big four, it didn't really matter, because you just went to one of the Irish banks and they gave you the money anyway. It just wasn't a problem, or it was a nice landing bank. All that foreign banking sector, of course, has disappeared. completely disappeared. So we have we have to refill that and that's why competition is so important. We do get more banks in this country into the SME lending area. That is extremely important. Secondly, we're obviously not going to go back to the high-risk property lending that we have, sub-certified mortgages and all that, and 25%, nonsense. We're clearly not going to go back to that. So in those two respects, banking has changed. But I don't think we're trying to tell people that we've got to go back to those particular things.
But we are in a roundabout way by complaining about net lending contracting. People in your department complaining about net lending contracting, when in fact what's happening is deleveraging is going on, and people are getting out of the self-certified and riskier mortgages that they shouldn't have been in the first place. So, are politicians trying to have it both ways?
Well, net lending to SMEs is falling. That's the problem. This isn't mortgage lending that's falling. It's SME lending, and that is extremely serious. Cash is drying up around SMEs, and we have to do something about that. And I think we're fully entitled to, accelerate the drive for more competition in banking, to ask the regulators to really rethink what they've been doing, as James has rather eloquently set out for you, and then to promote the alternative sources of finance, which we've read about tonight.
Julia, 5% returns, that sounds good.
Yeah.
Why isn't everyone flocking to you in large numbers? And can you give us any sense of risk attached to your business and others in your group?
Yeah, and I think the key thing is we don't make decisions for people and we don't assess risk for people. This is a direct investment, so it's not a fund for something that's pooled, it's not a collective investment scheme. The code of practice, which we've just signed off, is just to ensure people can understand what they're investing in. So it's transparent, it's in very simple terms, we're very clear about what the risks are, what the potential returns are, and where the fees might be. We think there's a 500 million pipeline just of renewable assets. In fact, the only contact I've had with Santander so far is when they called me to see if I could help them shift £25 million worth of solar farms through a retail bond, which is something we're very keen to do. Because if you look at a project like that, I think it's been in the ground for 2 years. The initial investment, the primary investment, was EIS-driven, short-term, sophisticated investors who wanted their money in for 3 years, a nice tax incentive for them to get out. And the perfect secondary market for that is my mum and dad, to whom 5% sounds like magnificent yield in the current market from that point of view. So I think definitely the two can work together from that perspective.
James, I think you've got a very compelling case about the problems that bank faces with regulation. Regulations for banks have been agreed at a global level at Basel, at a European level with CRD4, which took years to negotiate, gold-plated by the Bank of England at a domestic level with Mervyn King and his team insisting on yet more. Aren't you arguing for the absolute impossible? I mean, the idea that you're going to be able to unpick what effectively is a global agreement is just not going to happen, is it?
I'm not asking necessarily you unpick it. I think my point would be is that some of the regulators are trying to get us there a little bit too quickly. Bear in mind that under Basel III, you're not actually meant to get to your full capital requirements until 2019. The regulation in the UK for ring-fencing the banks actually isn't even through Parliament yet, and yet Lloyds Bank are already at their 17% primary loss absorbing capital. So there's been pressure from the regulators for everybody to get there early. And the Bank of England, in their financial policy committee report in November, said, look, we want the banks to reinforce their buffers. We're worried that their buffers aren't big enough. Well, actually, that's a question for the Bank of England, how big the buffer actually has to be. The Bank of England could allow the banks to run their buffers down. And that was the original idea behind funding for lending, was that, I actually think, if you look at where the banks are now, they're a lot safer than they used to be. RBS was 27 times levered, it's now 15 times levered. Barclays was 33 times levered, that's 19 times levered. They've all got 2.5 to 3 times as much capital as they used to have. And yet we've still got the Bank of England saying, and more please. Because if you're a regulator today, there's no upside for you saying, actually I'm going to cut you a little bit of slack. Because actually if you blow up in 5 years' time, I'm going to lose my job. Where every single regulator, that's why I made the CLO point as well, but it's true about Solvency II, which is for insurance companies. All the regulators are saying individually, actually, let's just tweak these regulations a bit further. And what you end up with is a much, much tighter regulatory system. Yes, we can get to a point where we have more capital and banks are safer. We don't have to do it right now. Because if you try and do it right now, you get what you've got, which is that bank lending just isn't growing. I mean, even though the funding for lending scheme last year, which was brought in, bank lending carried on contracting. And the point Steve made about, well, I've added 500 million of SME lends and I've taken away 3 billion odd of mortgage loans. And guess what? My capital is unchanged. That tells you everything you need to know about capital regulations.
Cool. Can I open up the floor to questions? I might just take them in pairs, if that's all right. Gentleman at the front. Yes, give me a minute.
Jonathan Thornton, Albion Ventures. It's 35 years since I went into financing small and medium-sized enterprises, and the question ICFC said to me is, do you know anything about lending, secured lending? I said, no. They said, great, we'll continue this talk. What we want is people who don't understand banking in the conventional sense. We want people who understand mezzanine financing, which Santander says they do now, which is lending against cash flow. Now, the other thing that came out was I was overpaid as a young MBA, and I never covered my overheads with fees or interest margin between what we lent at and what we borrowed at, because I was doing the smaller end, and the people doing the larger end covered that cost. And that is still a problem. And I'm now a director of a venture capital trust and on an investment committee where I've been this afternoon. And what makes it work in England is that there's a tax incentive. We earn 5% on average on our investments, but for the investor it's 12%. And that's due to the tax breaks, which is a brilliant scheme that's been going since the mid-90s. And so the reality is you've got to bridge those things. People who understand cash flow lending, which is very different from security. Steve mentioned it, ask for the chap's house. The first thing I suggest is get the person out of guaranteeing the house to their credit bank, because who wants a managing director who So it's got to be unsecured, cash flow based, mezzanine, which means looking only at the cash flow. And I'm now chairman of a social investing fund where we're doing that same thing with in several less affluent countries, and we lend to. They can't believe they can get money from us without any security. But it's up. We're making a judgment on the character, which is the relationship banking that came out from Steve. You've got to understand these people. Do you trust them? They don't use a computer. Do you trust them? So you've got that, and I don't know how to get around the subsidy thing. You need large organisations to cross-subsidise. We get around in our social investing fund by using early retirees who give their time for nothing. But that's not a maintainable solution.
And that's
My name is Bruce Davis, so I helped create Zopa and I now run Abundance, so we do crowdfunding now. I guess my question is, are banks really the best model to try and grow the economy? So they sound quite inefficient. I know your technology is quite old. Surely crowdfunders represent a more efficient mechanism for getting money direct into the economy, and we give better returns to our investors and savers. So I'm trying to work out why the incentives seem to switch towards the banks to try and get them to reawaken, largely the incentives towards smaller, yes, but fast-growing crowdfunding platforms. There's no level playing field. We don't get the same incentives. We're not treated the same way because we don't look and act like a bank. And having been the first retail regulated FSA authorised company to go through the FSA since 1997, because I didn't look like a bank, it took us 2 years. And that's a long time to be sitting there earning no money. So one of the problems is we don't look like banks, but we are actually better and more efficient than banks. So I guess the challenge is, why not support them more? Why not bring out, that will attract the investors, but there's other ways of attracting investors.
Steve, I just wondered whether you could talk for a moment on to this gentleman's point. People often make initial investment in their own businesses by going to the bank and securing it against their property. Mm-hmm. In today's environment where properties outside London are declining in value, you just wouldn't walk into a bank if you had done that and risk the chance that your house might be revalued and that could have consequential effects for your business. It's a very risky environment and a sort of uncertain way of doing things. To what extent do you think that the problems for business finance are caused by the way and shape of business of lending, the place in the boom years that structurally just doesn't work in these leaner times.
It's a complex question because, as an individual and as a banker, I'm not in favour of taking charge over someone's house. I would pretty much put it towards the bottom of a very long list of things I would do before I got there. I think it's probably the last resort. So, having said that though, if someone comes to you with a business proposal and has no equity and wants you to fund it in its entirety, what is his or her skin in the game? And actually, if they haven't got cash, or they haven't got access to cash, or they're not prepared to go to an angel investor or whatever else it is, then maybe the way to turn their business into reality is that you take a second charge over their house. So I can see, there are two sides to the argument. If you sort of said, you know what, you can rock up at a bank, and if you've got a good idea, they'll give you the money, it will be a chaos, right? Because you have no idea how many people have bright ideas in the shower and then write to me about financing. And most of them are nuts. And the challenge is that everyone thinks they've got a good idea. So I think you've got to have a balance between equity and debt. If you go back to the problems of the boom period, when you push bank, your senior debt leverage, which should arguably be 3 or 4 times logically, was being pushed at 7, 8, 9, 10. Then I think these are the businesses where you've got the challenge because they've still got probably leverage at 7, 8 or 9 times. They're probably okay, but they're very hard to refinance. And these are the businesses that I worry about because these are the ones that get caught because they've got nowhere to go. They've got slightly too much leverage, nobody really wants them, and yet actually they're viable, they're doing okay, and with a slight tweak to their capital structure they could do very well and they could then start to invest. I mean, I see lots of cases where the guy comes to me and says, I'm a 7 or 8 times, but if I put a wing on my hotel, I think I can kind of get back to 6, but I need to go to 10 to get back to 6. And we try and find a way to make that happen, and that's why Breakthrough was developed. Breakthrough was developed to say, okay, I'll go from 8 to 10, because I believe they'll go back to 6. But you know what, when you go back to 6, you need to refinance yourself as senior debt and repay the expensive mezz. Whereas actually the canons of lending would say the mezz comes out behind the senior debt. So again, you've got to look at I think you've got to look at capital structure, and you've also actually, as a banking industry, we've done this quite a lot of thought recently, maybe challenge some of the traditional canons of lending and say, do you know what, they're kind of outlived their purpose and we need to think differently and innovate slightly differently. And in response to the question about the emergence of peer-to-peer lenders, the regulatory process is really for Michael to comment on, but what banks do, for good or bad, and there is no other kind of sort of comparable entity in the UK economy, is they take deposits from basically you guys, who basically want it back tomorrow if they can, and don't really want to take a lot of risk. And they recycle it into long-term capital, whether that's long-term capital in businesses, long-term capital in mortgages, or whatever else it is. They take the maturity transformation risk, and they take the investor transformation risk. And actually, there are no other entities who can take that maturity transformation risk and that investor transformation risk at the scale that UK banks do today. So therefore, it probably makes a lot of sense to spend some time making sure those banks work to their best possible effect, because they are channeling multiples of what people I think are prepared to put into peer-to-peer funding today, notwithstanding the impressive growth trajectories that you've got. I mean, people who go into peer-to-peer lending have got to they get a good return, but they've got to be comfortable with the fact that they're there on a very different risk profile and a very different trajectory to sticking your money in one of my 1, 2, 3 accounts or an ISA account where if you change your mind tomorrow you can get it back.
So, Julian, you've got the Minister here. Regulatory hurdles, lack of enthusiasm from the FSA. What problems of extending to scale? What are the priorities? What do you want from Michael? What do you think is realistic?
Am I limited in number of the class?
No.
3, Michael?
Until he goes green.
And so Christmas? No, I think Bruce made a very good point actually. Level playing field is really what we're talking about, on tax and on incentives and just inclusion and government support in things like funding for lending. There's no reason why funding for lending a business bank couldn't apply to alternative finance as well. We just want to have a seat around the table when policymakers are discussing the future of how things are done. But we would arrogantly say that we think innovation is more likely to come from outside the sector, from within. Obviously, I would say that. And I guess if I had one big fat wish, it would be that we were on the ISA list for next year.
Can I get to Michael first? Michael, funding for lending, could that be extended to peer-to-peer?
Well, why not?
Well, one reason why not is because they don't have the security to post with the Bank of England to support it. I mean, this is not free money. You know, I have to post roughly 120% of every loan I take in collateral. So I post 120% of residential mortgage securities for every loan I get. So if I borrow $1 billion, I've got to put 1.2 billion of mortgages behind it. This is not free money. You know, there's a kind of sorry.
0.5% it costs you.
Well, it costs me on my current trajectory. It'll cost me somewhere between 125 and 150 basis points. And I post more collateral behind it than I do to securitise. I can securitise in the US market at 60 basis points on less collateral. So it's not. I'm more than happy for you guys to have access to it, but let's be very clear: this is not free money.
I mean, the Big Four's central argument is that only they have the kind of only they have the weight and the systems and all the rest of it. I'm increasingly sceptical about this. I'm not really sure about whether the drive to innovation is actually coming outside the banks altogether, and really whether the banks deserve a protected position at central borders. That is why we have opened up the payment system to the smaller banks. But I think equally we need to look and see if we can open up some of these schemes to the non-banks.
Because the FSA really are only regulating those that are already in the camp. So they're only responsible for making sure there's competition and innovation in that little magic circle. I don't really love the argument that scale is the reason why we have to keep things the way we are. I think the scale of the big banks is one of the big issues we've got. And when they get too big to fail, keeping them that size is not what I want to hear.
But Steve is right, isn't he? I mean, you don't have bundles of debt, assets that need swapping with the Bank of England in return for liquidity.
No, we don't. But I think that the cap really at the moment, particularly if you look at the peer-to-peer lending, if you ask the guys at Zopa or Funding Circle, what they're going to say is it's the lack of tax breaks, it's the fact that they can't get into SIPs, it's the fact that unsecured cash loans aren't currently regulated. And I try and explain to people what the difference is between an unsecured cash loan and a retail bond. And some days I can't understand the difference between unsecured cash loan and retail bond. It's lending money to existing businesses who've been around for at least 3 years with proven revenue streams on a cash basis. Why one is regulated and one isn't makes no sense to me at all. And if it doesn't make sense to me, it doesn't make sense to the consumers out there. And that's effectively a barrier to the adoption of crowdfunding going through.
More questions. At the back on the left, the woman standing up.
Hi, good evening. My name is Paola Cuneo, and I help small companies to grow their revenue through customer acquisitions. So two the companies I'm working with, they know they want to grow, they have a sustainable business, but to grow they have to invest, and mainly they have to invest in resources. Now, they have this situation where they don't want to go back to the bank because they feel they're already overstretched, and if they stretch themselves more, then the business will suffer potentially job losses. They cannot go to the business angels because they are services business, and the business angels rightly like to invest in products. So they are stuck there is potential to grow, they have a sustainable business, they have valued customers, so where should they go? And it dawned on me, today I was at Innovate UK, and Vince Cable was very passionate about investing and funding for SMEs. But it dawned on me that right now for high-tech companies, and R&D, there's lots of other ways to finance. There's TSB and there's IS, ACS, but what is the service industry?
But your concern is that if your companies go back to the banks, then they might insist on slashing costs and job cuts.
Yeah, they feel that if they stretch themselves, they take additional loan and then they cannot repay, the business goes down. So even they exist, so they will be resulting in job losses. So the challenge is they don't want to go back to the bank to borrow more. So in this case, the problem is not the bank. The problem is how do they find other ways to invest, because they are not a high-tech business. High-tech business could go to business angels, for example. So is crowdfunding the answer?
Yes. What was the question? No, I don't think it's an interesting example. I don't know if you saw the Hotel du Chocolat bond, the retail bond that went out, was really oversubscribed. So we are intrigued with the idea that the customer can be the investor at the same time. So if somebody's looking, say, for cash flow to diversify or to grow or to come up with a new product or service, if you have a loyal customer base, that is one place to look to. So the Hotel du Chocolat bond was beautiful because they raised a significant amount of money and the coupon they paid was on chocolates. So the people who bought the bonds were thinking, holy moly, normally this box of chocolate costs me £25 a month. That equates to a 10% return, how fantastic. Whereas for Hotel du Chocolat, the chocolates didn't cost them £25 a month to make. So it's a high perceived value to the customers who are more bonded to the company as customers and a low cost to the business. I mean, what's not to love?
James, just out of interest, what did you make of that case at the back? Should a bank be prepared to lend to a customer like that, to a high-tech business, and be expected not to, call in if the business if the investment doesn't work out? I mean, isn't that just what banks do? You can't really criticise them for
Well, I mean,
turning down or for setting those sorts of conditions.
Well, I would kind of argue that where I sort of started when I talked about two problems in the UK, that we've got problems in that we don't have enough supply of SME lending, and I said that we don't have enough equity and venture capital. And to be honest, for high-tech companies, for those kind of companies, they're really the ones. That's it comes back to what Steve was saying about the right type of capital. Not every business should be taking a loan. Some of them should be taking equity capital, some of them should be taking less capital. At the end of the day, if the business doesn't work out, you have to shut them down to get your money back. If you're whether you're an investor, whether you're a lender, whether it's mezzanine, whether it's equity. Sometimes you can refinance, sometimes you can make it go, but sometimes companies fail. It's just a matter of fact.
The gentleman over there, the three from the back, further from the back, and then just
thank you. Mike Dent from the Modern Masonry Alliance. I represent a lot of small businesses, manufacturing businesses, and they depend on demand from small house builders and small builders. If SMEs are the engine of the economy, then building our way out of this recession is the most likely way we're going to create the growth and jobs that we need quickly. However, you go to the banks as a small SME, whether you're a house builder or a manufacturer, and construction's a dirty word, and we're dismissed at the door for having come from that horrible industry. So how can we stop the prejudice actually that's going on in banking at the moment and start thinking about what's good for UK PLC?
One more.
Thanks very much, David Duconi from Funding Circle. We're a business lender. Firstly, to Michael, I think we were the first branch of the Business Finance Partnership that was announced back in December, and this is the first time the government will lend £20 million through our platform directly to small businesses. And I think they do need to be commended for that as a first step of non-bank lending. There's a great deal that both peer-to-peer lending and crowdfunding can do, and the £100 million pot that the BIS has initially, and hopefully potential work that can go on with the business bank does sound very encouraging for hopefully building the industry over the next few years to really provide kind of quick finance for businesses. The point wasn't just to wax lyrical about how good this was, though, unfortunately. The point I wanted to make was about speed versus price. Funding for lending, our analysis shows, if it's there to cut interest rates by about 1%, on an average loan of about 75,000, will save a business owner about £32 a month. It's about £384 a year. If you're turning over £1 million or so, is that change actually a really major source for you? Is that going to get you to go down the bank? And actually, is it not that the speed of finance is a lot more important to businesses? So there are many businesses that come to us that say, we need finance in a number of weeks because we have a busy period coming up and we need to buy stock for that. And actually, ensuring we get that finance is much more important than potentially waiting months or so until you get an answer from our bank. So I think just raising the question, is enough being done to focus on the speed of access to finance for small businesses?
Michael, can I come to you first? Can I just pick up on the theme underlying both of those questions? 85% of lending, I think you said, comes from businesses of the big four. Is it a government objective to reduce that number? Should it be a government objective to reduce that number, or just common sense? And do you think that it's important to help other sources of finance populate this market as well? And are there other things that you can do to speed up the way that these companies, alternative non-bank companies, can get money into small business?
Well, on the first, I said that the concentration is unhealthy. I don't think it's given us the innovation we need, and I think there's plenty of evidence that it's building in too much cost into all these rather expensive systems. So I do think it's unhealthy, and I do want to see more banks come forward. That's how Handelsbanken has done, Santander and Co-op, and now lending quite heavily in the small business sector. I think that's encouraging. But I also want to see new banks come through altogether. And the FSA has got to speed up that particular process.
Just about, is there anything else you can do to do you think?
No, I think we had a bid for the remaining 45 million or whatever it is there. We have started down this road, but we're in some considerable sums in it.
Is it going to come through the business bank, this kind of funding?
Because eventually it's all going to be brought within the business bank, so there was a plea, I think, to get all this stuff better coordinated. To get this all better coordinated and better branded, so that it's not two bits and pieces across the sector.
It does feel like the business bank is sort of inching into existence rather than taking great strides.
Well, it was announced in October.
I'm sure people
now it's March. Setting up a bank in this country, not as we just heard, it usually takes 5 to 7 years. We set up the Green Investment Bank in 2 years. The business bank was only announced in October. And we're already putting money aside, and it will start investing this year.
Can we help?
I think Vince Cable's people said that the first lending might be happening in 18 months, so it's still time.
Yeah, but we're doing other things before that. We're already working away on the wholesale interventions they're going to make and so on. So there's plenty of work they can do before they actually start lending.
Can you explain what wholesale interventions means in this context?
I don't want to go too much into what they're planning, but they are working away at improving some of the wholesale funding streams that can be available to SMEs, building on what we're already doing in the Department of Enterprise for Capital and so on.
Thank you. Too concentrated, unhealthy, too much cost. Would you agree?
Well, I think that there are some valid observations, but there are also some less valid observations. I mean, I think that it's interesting when you kind of think about building a bank that is a full-service bank for SMEs. When I arrived at Santander, we didn't have any products or any capability or any of the things that RBS or HSBC or Lloyds had. We built them all from scratch. We could do invoice financing, we could do asset finance, we could do FX, we could do rate risk management, we could do trade finance, lending, deposits, and all the other bits and pieces. But frankly, without access to Santander's capital base and without access to Santander's IT investment, it would have taken a hell of a lot longer than it's currently taken me. And even now, I kind of feel I've got a car with wheels on, but my competitors are probably, they've got 6 gears and I've probably got 3. And it'll take me another couple of years to get the other 3 gears in place. So building out a full-service corporate and commercial bank, which is what SMEs want. They want you to be able to support them when they want to trade in Brazil. They want you to be able to do foreign exchange. They want you to do asset finance. They want you to do invoice finance. They like the idea of having all their eggs in one basket. I'm not saying they're right, but that's kind of what they want. Then you have to build this infrastructure. It is not cheap. Someone gives you the capital, they do expect a return on that capital, and therefore you have to try and construct a business model that achieves a sensible return over the cycle, which is a mix of the costs you invest on an OPEX basis, as well as the risks and the losses you're prepared to absorb. Now, we probably run a return on equity in our corporate banking business, which is way below the cost of equity at this moment in time. But we think that once we reach maturity, it'll be a good business. But I think you've got to go into these things in a very realistic and honest way, and not sort of be entranced by the sexy parts and without understanding that there's a lot of complex. Businesses like to have money moved around. When money isn't moved around, they get very upset about it. There's a big payment system that moves money around the system.
James mentioned the question of the ring fencing. in this country we are going through a big regulatory process that will ring fence off the retail arms, the high street arms of the banking sector, so you would be entirely within the ring fence, protected from others in your group. On Friday, the government actually, for the first time, gave an indication of what would be allowed and what wouldn't be allowed in terms of derivatives, which goes to what you were just talking about. What did you think of those rules? Were they drawn? Were you happy with them? Were they drawn too slightly?
I think at the end of the day, I mean, clearly there's a lot written about interest rate derivatives, and clearly there are some very unfortunate cases which are being looked at this moment in time. But I think offering an SME the choice, not the obligation, but the choice to make a hedging decision in respect to their foreign exchange position or their interest rate position is important. I don't think it should be an obligation, but I think it should be a choice.
And so is everything that you want to be inside the ring fence bank?
I think if you're able to offer an SME the ability to hedge their dollars from Brazil or wherever, and the ability to hedge their interest rate with simple products, that is fine. I think, I think actually, if I look at my ring fence bank, which will have £160 billion of mortgages in it, my hedging requirements in terms of offering fixed rate mortgages and managing fixed rate savings will dwarf the whatever I offer SMEs in terms of derivatives. I mean, running a balance sheet with £160 billion on the side of it requires you to take some quite, you have to manage those fixed rate and those floating rate flows. So if I look at what I'll end up with in the ring fence bank, I'll end up with a lot of hedging of my mortgage book and my savings book, and a very small percentage of SME derivatives.
A couple more questions. Woman at the front and then gentleman towards the back.
History and Historical Research, University of London. I focus mainly on my work as a researcher and writer on the European Union. But I've dabbled in business off and on over the years, and I'm very interested in this subject. And my background is both American and British, so I have both perspectives. And interestingly, I mean, I'm very aware of the fact that, yes, Americans who want to start a business or expand a business, unless the business is very tiny and they only need a microloan, or unless they're already big and they need a few $100 million, they don't think in terms of banks at all. It's banks is not in the picture. They think private equity. Friends and family is the first step, and angels and VCs, especially angels, are the next step. Here, people don't think in those terms, but I've experienced how easy it is to get offers of equity funding, because in my dabbling in business, when was it? About 10 years ago, I think. I had an offer from a gentleman who was a banker, an investment banker with a major German bank. The global equity arm was based in London. And he came to me, an organization called London First at the time. It was always looking for new businesses to build up London. Put him in touch with me, and he offered me matching funding. At the time, I was looking for a little over £1 million, and he offered, so not tiny but not large funding. And he offered matching funding, and I needed to find the other half. And I had a similar experience actually with a bank, with one of the big four banks some years before that, the same project at an early stage, offering me, believe it or not, matching funding, temporarily taking equity. So it's there. It's the entrepreneurs that have not been taught to go and look. There are lots of angels to go to, and I think it's up, Mr. Fallon, I think it's up to the government to start persuading people, try to find the private equity.
David Millican from Reuters. We heard some criticism earlier about the sort of Bank of England and other regulators wanting sort of higher sort of capital levels than sort of has been required previously. When faced with that criticism, they always say that having sort of higher capital levels will reduce the sort of funding costs for banks. It will be lower cost for them to raise money from the
market, and so actually the cost of higher capital levels is a lot less than is made out. Are they right about that, or have they got that completely wrong? And if so, sort of, why haven't you been able to convince them of that?
I'm going to start with James. Are British entrepreneurs unadventurous? We've never been able to get a kind of collateralised SME bond market off the ground, despite 30 years of trying. Maybe the business bank will succeed. But really, if the money's out there, why do they keep going back to banks?
Well, I think I said at the beginning, I felt our kind of venture capital extra needed to be broader and needed to be more available. And I think your example was probably the exception that proves the rule. In that if you happen to bump into the right person at the right time, you can find equity capital. And in terms of a lot of business angel networks which are being set up, you literally come on things by accident. I mean, I can't remember a couple of those, and you find businesses by accident. What we don't have in the UK, which you have in the US, is a system where people go there and people also expect to be able to provide that kind of equity capital. And it's something we need to put a lot more focus on in this country than actually developing.
I have to say, obviously, perfect solution in crowdfunding, inevitable answer. I think the US and the UK are very different. When I've been raising money for my businesses, when you go and see the US VCs, they will give you enough money to give you a decent run at something. And they will look at the valuation of the business on the basis of, I need to get that girl fully motivated for the next 3 years so she doesn't want to breed or sleep and just produce the returns. You see the UK VCs, they go, I'm going to give you a whole quarter's worth of money, and if you do very, very well and hit the milestones, come back, we'll give you more. So it's a completely different context to raise it in. So I think crowdfunding is exactly that, because it is hard to matchmake the opportunities of the investors, and I'm sorry, boys, but technology really can be the answer to that. That's how communities work. That's how you can find what's out there very easily. So I think on the fundamental shift to the Cedars and Crowdcube and others, yes, they're sitting at 6 million, it's small fry. But the key restriction we have there is, with the exception of abundance generation, none of the crowdfunding platforms can open up their doors unless you are a sophisticated investor or a high net worth individual from that point of view. Now, I don't want Granny to take her whole £100,000 and put it into a silicon roundabout startup and lose it all. Nobody does. But I've worked hard, I've earned my money, I've paid my tax, and where anybody gets off telling me I can't put 50 quid into something I have a passion for, I don't know. So I think there's real potential to get a lot more investors and new asset class through in the UK, and it's coming.
Michael, is there an education room, or is just increasing capital over and over again the banks going to squeeze investors into the arms and other types of lenders?
So is that the first question?
It's an extra question.
Can you repeat that?
So, do you think that there is a role for education in encouraging...
To tell entrepreneurs what to do? No, I think we ought to be more systematic about these angel networks. It does seem terribly haphazard. Maybe, using new technology, there is something we can do there to stitch these networks together and make sure people can access them more easily. I think there's certainly a role there.
And just on capital more generally, you've heard what James has to say, the gentleman from Reuters. Is there does government appreciate some of the stresses and strains that obligation after obligation is being put on the banks in terms of capital buffers?
Well, we do. I mean, the banks come and tell us that all the time. I mean, that is their, apart from saying there isn't sufficient demand for SME lending, that is their other great excuse. But we need to test that. And we do need to, I think, push the regulators on their appetite for actually relaxing some of these requirements. We should be way gold-plated about what is actually required on commercial. So we do need to do that.
Well, Michael, thank you very much indeed for joining us.
I'm sorry.
Thank you very much indeed. It's a quick. I think that would be a good point just to maybe sum up some of the things that we've heard. Steve, would you like to kick off?
Well, I was going to sort of address a couple of questions that kind of haven't been covered. So I think in answer to the guy from Reuters, if you assume that a ring-fenced bank will carry total capital of 17%, which is kind of what's implied under the current proposals, and that has an average cost of 12%, give or take, and you can fund yourself in the wholesale markets at, say, 60 to 100 basis points, it shouldn't take you too long to do the maths that says actually there is absolutely no subsidy big enough in the wholesale funding model to cover your cost of equity being doubled. So in other words, it just doesn't work. Because there isn't sufficient fat in the current funding cost to argue that if you're more heavily capitalised, you'll get a discount on your current funding cost. Even if your current funding cost went to zero, you probably save somewhere between 60 and 70 basis points, and yet you're probably paying out 12% on your equity, and your equity's doubled. So it doesn't make any sense. And in answer to the question about lending money to house builders, I've got a lot of sympathy with that. I mean, I do believe that debt should be something that is capable of being financed by certain or near certain cash flows. And I think probably banks have become overly cautious about the prospects for house builders building houses and selling them, largely as a consequence of some hiccups around about 2008, 2009 when supply and demand did get out of kilter. But all those companies who got out of kilter in 2008 and 2009, they're all kind of back on the straight and narrow now. So I mean, look at the results from Persimmon and Bovis and these guys recently. They've all been great results. Great management in terms of recovering from where they were in 2008 and 2009. I don't see any reason why that can't be replicated with smaller house builders. So my view is that we should be more positive on lending into the house building sector. Certainly within Santander, given that I can effectively finance a lot of the houses that if I choose to finance houses, there'll be a bill. I can also, arrange my exit finance through mortgages. So it kind of seems a slightly obvious thing to look at. I think that there is, if you kind of reflect on it in a dispassionate way, then I think the knee-jerk reaction to the crisis in terms of appetite for risk and lending has been more severe than perhaps it should have been, and has gone on for a lot longer than it should have done. There are a number of factors behind that. Capital, liquidity play their part in that, but risk aversion probably plays the biggest part. And in my view, risk management of an institution is important, and you need to balance risk management with capital, with liquidity. But also, you run an enterprise at the end of the day. You should be able to kind of manage those things in tandem to get to a level where your business grows, it supports its customers, it provides the service it needs to. And therefore, I feel that this is soluble. I think actually the advent of peer-to-peer funding, different innovations, technology will challenge the banking sector, and will challenge the banking sector for good. And I don't have a problem with that at all. I think there's kind of plenty of opportunity for everybody. It's not a question that I'll be running a dinosaur that's going to get wiped out by a meteorite with peer-to-peer lending on it at some point in the future. My kind of view is that there's enough kind of stuff for us all to eat, and therefore I encourage competition, and I think it would be great for the economy.
Yeah, shameless plug. So when you have half an hour free at work tomorrow, take a look at Funding Circle, take a look at Zopa, look at Cedars, look at Crowdcube, go and see what's going on, and think about whether a couple of % of your capital wealth could be better deployed somewhere where you can see where it is, where it's doing some good, where the returns are net and there's no chunky fees. Abundance generation, I think, actually is simple from that point of view, but please satisfy your curiosity and have a look and see whether you think it's got potential. Assess for yourselves.
Maybe I'll just answer the question about Reuters first. The answer is that the Bank of England dig their textbooks out and they say, well, actually all forms of funding are equal at the end of the day, and actually in reality it isn't. I mean, in all likelihood, they're probably going to ask RBS to raise in the region of about $5 billion. They'll probably have to buy a contingent bond, which will cost them about 8%. So it'll cost them about $400 million a year just to actually service their current loan book. So, the Bank of England's analysis, I think, simply doesn't actually work. On the other stuff we've heard this evening, I think there is scope for new types of funding to come in. I think Michael's got a lot of work to do. A, persuade the Bank of England to actually back off on capital requirements, but B, also joining up things like a lot of the equity and venture capital investment schemes. Can we use crowdfunding? Can we use peer-to-peer lending? Can we actually integrate all of these into creating more forms of capital for banks? And I'm sure, in many cases, banks would sometimes feel happier lending alongside equity that's been raised through these kind of crowdsourcing networks. So I think there's scope to go forward. I think we need to develop the whole package for SMEs.
Thank you. No, we've heard a lot of interesting stuff. Clearly, the minister who's already gone has concerns in all directions, both with the Bank of England and their gold plating, and with the banks themselves and the way they're behaving. But the process of helping organisations such as yours is only at an early stage, so they probably need to get their skates on. Thank you all very much for coming. Thank you to James, thank you to Juliet, thank you to Stephen and to Michael who's gone, and good night.